welcome, Fannie. I would love to start with something of a global investment landscape. And this whole morning, we keep hearing over and over again on this concept of U.S. exceptionalism and whether that's kind of over. So as Europe's largest asset manager, I'm curious, what are you hearing from your clients and how do you see that playing out in the rest of 2025?
First of all, I'm very delighted to be with you here. And obviously, the music this morning has been about diversification and all of the questions that you raised. When we discuss with all of our clients all around the world, most of them are kind of cautious nowadays, exactly for the purpose and the questions we all discussed this morning, and notably linked to the uncertainty of the US policy. When they say cautious, they are cautious obviously about US assets to wait for more clarity, and also a bit cautious about all of the markets that are very much dependent on who can be significantly affected by US tariffs. For now, we are starting to see some reallocation, even though it's a bit too early to confirm a definitive trend. But what is striking is that we are actually seeing a structural shift, and this is what has been discussed as well this morning, is the need for greater diversification in portfolio. What has been also discussed this morning, and this is something we are hearing from all of our clients, is how they can diversify as well from the dollar, which didn't play so far its role as safeguard or risk-free assets. And actually, in one of the panels this morning, two of your respondents say, can we consider dollar as a risk-free asset? They say maybe, maybe not moving forward. So all in all the discussion we're having with our clients is how can we help them and what will be a key diversifications towards their portfolio moving forward.
And where does that leave other major markets like Europe and Asia? What are you seeing in terms of the fund flows?
Yeah, actually, exactly to your point, we are seeing three major themes nowadays into the client's portfolio. At first, we do believe that we are in a pivotal moment for Europe, obviously. Even though the growth potential are still modest, there are some catalysts that are playing their role and that are currently in place. Everyone is speaking and actually witnessing and expecting increased spending into the defense sectors. There's been as well some fiscal push in Germany, and obviously ECB will be supportive in terms of liquidity. All of that should also play and be in favor of a re-rating about European equities. And if we want to turn it into practically into what we're observing in terms of flows, and if we take the ETF market as a proxy and short-term reallocation of potential flows, this year's flows into the UCITS market, which is European and international investors, are 4 times higher into European equities than US equities. So actually, we're seeing some kind of shift into the allocation. The second, actually, and to that point, last year, it was 10 times the opposite, 10 times higher flows into US equity, whereas to European equities. The second actually themes that we are actually hearing, and that has been a key topic this morning as well, is that a lot of our clients are finding appealing stories in Asia, actually. Obviously, because Asia play a crucial role into the global supply chain. There are sentiment and flows that are improving. There might be good earnings surprise. Asia rates offer good value relative terms to other, I will say, currencies. Asian central banks will be positioned to potentially cut rates. And obviously, we are seeing it as well in terms of flows, whereas this year, the flows toward emerging and also Asian equities are as high as in US equity into UCITS market. So it's kind of a reverse trend. And the last one, obviously, and that has been as well discussed this morning, is definitely gold. Gold has performed very well. There's been some demand for central banks, and gold actually is playing a role as a hedge and safeguard assets to any client's portfolios.
Yeah, and shifting to Asia, it's a very diverse and dynamic region. We just had 2 panels on India and Japan, which seems to be gaining a lot of attraction these days. So which geographic location or asset class do you see in Asia that's more promising?
If you look at Asia ETF markets, actually the growth has always been driven by, I will say, 3 factors. Obviously, there is regulatory reforms coming into place into many markets. There is obviously a demographic shift. Actually, we all agree that the growth is here and actually witnessing the growth everywhere in all markets in Asia. And obviously, there is a rise of digital distribution and actually digitalization, which enable a mass, I will say, adoption of our savings from clients. Usually when there is an ETF acceleration, there needs to be 2 factors which are currently putting in place into Asia. At first, we need the development of tax incentivized schemes which are actually taking place. And second, obviously, they need to have regulatory support. So if we take some true example into Asia, obviously Japan has been witnessing an expansion with the NISA scheme. In Hong Kong, there is a great momentum with the eMPF and the ETF Connect. In South Asia, and notably Singapore, we see a rise of digital actors moving fast, and there is already a big retirement scheme in place. Taiwan are changing rules for active ETFs. So all of that are creating actually very good conditions for broader, I will say, growth of the markets. And this should encourage, obviously, retail investments and long-term savings flows, which will benefit to, obviously, passive and ETF as well.
Any expansion plans for Amundi in those places?
Well, actually, I mean, we are the largest European UCITS provider and manage 400 billion. So obviously, we are witnessing and monitoring all of those developments with any of our local teams and accompanying our clients once they want to get ready or exposed to those markets. Yeah.
Gotcha. I want to shift to the private markets because it's something that's been on a lot of conversations among ultra high net worths in this region. Have you seen any change in terms of how the wealthy investors in this region view private allocation?
Yeah, when we look about private markets, actually, and ultra high net worth, so I will say private individual, the allocation is still very small. It's less than 5% of their overall portfolio, and it estimates to represent roughly $2 trillion today. But the adoption is getting actually growing and accelerating, and we expect that amount or that percentage of 2% or $2 trillion to triple over the next few years. There is actually, private markets are appealing for ultra high or private clients for many reasons. The first one is that in a low risk environment, obviously there is a need for new sources of yields and obviously for diversification in portfolios. But that is also, I will say, supported by a strong demand, actually. Corporates need ongoing financing and refinancing, and the bank are less, I will say, present in the sub-investment grade lending businesses. And so all in all, what we see, to your point and to your question about where the demand is evolving, is that ultra high net worth has been historically focusing into single strategy or willing to get exposed to, I will say, single strategy to diversification and return. But we see more and more demand for multi-manager or fund of fund, and notably to evergreen products, which enable either private banking clients or mass affluent clients to get exposed to a full diversified private markets portfolio. One point of attention is that we should focus obviously on the liquidity, we should focus on the suitability for clients, and that will require an enormous amount of financial education if we want to make sure we get the right investor protection.
Yeah. And this is something for our audiences that come from mainland China, because I know Amundi has a big wealth management business there. So have you noticed any change in terms of risk appetite among wealthy Chinese investors? And well, how does that reflect their product preferences, for example?
Yeah, obviously the Chinese market is a fascinating market and very dynamic market. And actually we have long-term commitment at Amundi towards China. Out of the ongoing conversation we're having with our clients in China, and obviously on the back of year-to-date volatility, we see China wealth clients being currently very cautious. Cautious means that their allocation to fixed income is the mainstream of their allocation, but they are also looking for high dividend and notably stable return products. The second actually effect is obviously they are looking for diversification, and they are looking as well to offshore product just to get a bit of higher return, and once again to diversify the currency risk nowadays.
Mm-hmm. And in terms of their global diversification, it's a tough time for them. There's so much geopolitical uncertainty. There's US-China trade tensions that are still kind of going on. So which other international markets might they want to diversify their money into?
Well, actually, it comes back to the initial discussion. There are, I will say, three big themes that we are witnessing into, I will say, our conversation with our clients locally on the ground. Obviously, they start to see initial interest into European equities, even though still not, I would say, confirmed nowadays. There is obviously strong appetite for gold that has been performing very well for the last 2 years. And actually, we cannot ignore neither the DeepSeek moments and obviously the strong demand for tech and notably China tech stocks, given the context.
Yeah, and in terms of maybe their allocation to private markets, is there any specific products that they might prefer?
Like in general, private clients' adoptions to private markets is requesting, a lot of financial education and also making sure about the suitability of the product and notably the illiquidity of the product towards the allocation and the model portfolio of each client requesting long-term allocation. And this is where obviously discussing with lots of, I will say, wealth manager, evergreen solution might be best fitted towards a kind of more broader adoption.
Mm-hmm. I'm also curious about crypto. This is something that I heard a lot of family offices here wanted to add more exposure, but haven't done so. Have you seen any innovation in the crypto ETF space here?
Obviously, crypto has been gathering a lot of media attention about the previous months, and obviously crypto as well has been meeting some of the demand of special group of investors and mostly the younger generation. We do believe that if we were to see a bigger or I'll say broader adoption, there still needs to be an harmonized, globalized regulatory framework about it, and still the industry has to get rid with some of the concern about the security of the assets deposited and as well about all of their, I will say, healthy value chains to be done. Mm-hmm. So all in all, I think the more the markets will mature and regulatory will jump in, the more actually the adoption and the broader adoption will be.
Mm-hmm. We have 2 minutes left, so one last question on the technology side. So this is something not just reshaping the wealth management industry, but also the financial industry as a whole. Especially in Asia, we've seen a lot of AI innovations recently. So how do you see that changing the way we work every day, and how do you adapt?
Well, it's a big question, and actually this is fascinating. Whenever we look at the asset and wealth, there is a massive transformation that is getting on the way. And coming later to your point on digitalization, the first massive transformation is the demographic shift. And we are seeing actually 70 trillion of wealth that is currently transitioning from baby boomer to the X, Y, and Z generation. And obviously this generation is much more tech savvy and actually tech friendly. So they act differently, they need deeper sophistication and integration. And this is where obviously this is shifting all of the business model from wealth management to adopt more technology. The banks are adopting technology to get actually much more mass affluent and retail, and obviously to capture the needs and the needs of those, I will say, younger generation. And on the other way around, all of the digital tech platforms are also upgrading them skills to be able to tackle the needs of much more wealthy clients to get upstream into wealth offering. Meaning that all of our industry actually has to capture and to make sure adapting to that wealth or digital technology challenges. For banks and wealth managers to enhance their, I would say, tools with their portfolio management or risk management, obviously to offer a greater client experience and then satisfaction, and obviously to be better efficient whenever they deploy any investment solutions towards their clients. So all in all, very positive developments for their industry.